My name is Venkata. I am explaining the taxation or income tax basic concepts. Okay, if you like my class, please like me, share me, and subscribe the video channel. Okay, let us go the topic. What is tax? What are the features of the tax? Tax అంటే ఏంటి? What is meant by tax and features of the tax? Okay, tax in India, Income Tax Act is 1961. 1961 is the Income Tax Act. Okay, so tax means tax is a sources of revenue to government contributed by public. Okay, tax is a sources of revenue to government contributed by the public. Okay, so taxes are imposed by the government on the public on different ways. Okay, what are the features in the taxation? Okay, let us. So Income Tax Act is 1961. Tax is sources of revenue to government contributed by the public. Features: compulsory payment. Tax is a compulsory payment imposed by the government who are liable to pay the tax. For example, if any person earn the income 1 crore rupees, he contributes 30% of income to the government. So it is a compulsory payment. For example, a actor earns for a movie for 20 crores, he will contribute 30%. It means 6 crores will be contributed for the tax to the government. No return benefit. So tax is a paying tax without getting any return benefit from the government. We should not expect any benefit from the government. Just we are paying the tax. Okay. Next, part of income sacrifice. Everyone should sacrifice the income to the government for social and economical welfare development of the country. Okay. Tax is a regular and periodical payment. Taxes are two types. They are direct taxes and indirect taxes. Taxes which are regularly paid, it means GST, 3 months, quarterly, half-yearly, it will be filing. Periodical means income tax will be paid at annually once in the time. Okay. Next, the tax amount is used by government for different purposes, like maintenance of the welfare, like government hospitals, government schools, colleges, pension schemes, etc. Economic development for construction of projects like dams, like canals, roads, communication facilities. The amount is by the government. Like special schemes like police department, maintenance of police department, army, navy. We have to pay the some part of our revenue to the government. Okay, the tax amount will be used for different ways by the government. Okay, those are the tax definition, feature, meaning and features. Okay, let us go to the next point. Second question is differences between direct tax and indirect tax. Okay, points. Direct tax is directly incurred and paid by the person to the government is direct tax. Indirect tax, it is paid by one person to the another person, is called indirect tax. Okay, so for example, if you purchase the goods by customer, he will pay the tax to the dealer. The dealer will pay to the tax to the government. So here indirect taxes are paid by one person to the another person indirectly. Indirect tax, the person who has earned income, he will pay the tax directly to the government. Okay, levied. Income tax, so here taxes are levied on income earned and acquiring the wealth of the SSC. Okay, so the tax will be levied on the income and wealth is the direct taxes, whereas indirect taxes are levied on the at the time of the sale and purchase of goods and services. Okay, next, shifting. There is no shifting of tax burden in direct tax. If a person who has imposed tax on him, he will only pay to the tax to the government. There is no shifting of tax burden in the direct tax. Whereas indirect tax, the tax burden will be shifting one person to the another person, like manufacturer to dealer, dealer to the customer, customer finally getting the taxes amount. Okay, ultimately indirect taxes will be collected from the customers, like public consumers will be paid the all taxes of the SSCs. Okay, next examples. Direct tax examples like income tax and wealth tax, whereas indirect tax examples like GST, goods and service taxes, and custom like import duty and export duty. Okay, next another question. SSC section 2 subsection 7, okay, is third point. SSC means the person who is liable to pay tax to the government is called SSC. In income tax, person will be called as a SSC. Okay, SSCs are classified into three types: ordinary SSC, deemed SSC, SSC in default. Ordinary SSC means the person who is liable to pay tax according to section under Income Tax Act of 1961 is called ordinary SSC or SSC, and the person who is paying advance tax to government is called ordinary SSC. The person who refund due to him asked by the person is called ordinary SSC. Okay, next deemed SSC or representative SSC. It means he is a person paying tax on behalf of the another person. He paying tax on behalf of the another person. He is called deemed SSC or representative SSC. If a person dies, the legal representative will pay the tax to the government. He is deemed SSC. Lubricant, minor, drunkard, idiot. The person's legal representatives are paid the tax by behalf of the minor, lubricant, idiot. He is called deemed as a representative SSC. If any property in the court custody, the trustees will pay the tax to the government. They are called the deemed SSCs or representative SSC. The person who are living in the outside India, the persons who are paying tax on behalf of the non-residents is called representative SSC. Okay, or deemed SSC. Next point, SSC in default. SSC in default means the person who is failed to pay TDS tax amount to the government. Simply say that the person who fails to pay tax in the government treasury, government account. So he is called SSC in default. It means simply say that the person who fails to pay tax is called SSC in default. Okay. Next. Assessment year and previous year. Assessment year and previous year. Assessment year is section 2 subsection 9. Okay, assessment year. Assessment year means it consider 12 months a period. Okay, assessment year is considered 12 months a period which starts from 1st April. Okay, which starts from 1st April and ends with the 31st March. Okay, this is the assessment year. Okay, assessment year means the year which is tax paid amount. Tax paid is assessment year. So for example, if you are paying tax amount for this year, this is the assessment year. Okay, so the income will be earned in the previous year will be taxable in the present year. Okay, for example, this year is 2022-23. This is the assessment year, means previous year is 2021-22 is the previous year. Okay, so assessment year is the tax amount paid year. Okay, tax amount paid year is called the assessment year. Okay, previous year means section 2 subsection 3. Previous year is also financial preceding the assessment year. Okay, so previous year is before and next is the assessment year. Okay, here previous year is that income which earned in the year. The income which earned during the year is called previous year. That amount will be taxable in the assessment year. Income earned period is the previous year. Tax paid amount is the assessment year. Okay. Next, for example, there are some years are given. So previous year 2021 to 2022 is the if previous year. This is the income earned tax paid. Okay, income earned in the previous year, income earned in 2022, the tax paid amount in the year 2022-23. If income earned in 2022-23, the tax amount paid in the 2023-24. If income earned in 2023 and 2024, the tax amount paid in the 2024 and 25. Okay, so previous year and assessment year is the year. Okay, here previous year is present, whichever year will be taken. Okay, next point. Sometimes the previous year and assessment year both are same in particular situations. What are the situations? If the income earned in the year will be taxable in the same year. Income earned in the year taxable in the same year. So previous year and assessment year both are same in particular situations. See the first situation, shipping businesses of the non-resident. If any ship comes to India, the tax amount will be levied at the same year only for non-residences. So non-residents, any person comes to India through shipping businesses, they will be taxable in the same year. Okay, the person who lives in India, the person who is living in India and leaves the India permanently, he will be closes all the transactions in India. He earned income and taxable in the same year. So the person who lives in India, he will be taxable in the same year. Next, AOP and Association of Persons, body of individuals formed for a particular event. If anyone conducting in a particular event like IPL matches, they are conducting the particular season, that the amount will be also will be taxable to the same year. For this reason, what the reason means, there is a foreign player will be comes to India and taxable in the same situation, same event and only. So it is will be taxable in the same year. The persons who likes transfer to property another persons to avoid the tax, so that will be also taxable in the same year only. Next point, discontinuous business. It means drop out the businesses also should submit their income IT returns to the government. For discontinued businesses also, if there is a possibility of any income in the discontinued business, the same amount will be taxable in the same year. So previous year, assessment year, same in the 4-5 situations. Shipping businesses and person who lives in India, the person who conducts particular events like AOP and BOIs, and next for property transfer to another person to avoid the tax and discontinued businesses. Okay, next point, unexplained incomes or undisclosed incomes. What are the? It means income earned but not shown in the books. If any IT raids will be happened, the unexplained incomes will be asked by the income tax officers or assessing officers. Unexplained cash credit. If there is any cash amount created in the accounting books without any explanation, then it will be taxable. Okay. Unexplained investment. There is any investment in the purchasing of any assets, purchasing of any buildings, purchasing of any cars, like any investment in another companies. In what way the investment amount will be earned? If there is no proofs, it will be also taxable. Okay. Unexplained money, unexplained gold, unexplained shares, unexplained valuable articles are also taxable in the income. Okay. Unexplained expense. If there is function, grand event will be conducted, the IT persons will be observing the person and asking the several questions, which amount you have spent in the functions, which amount will be for expenditure in the politicals. So it unexplained expenditure is also will be treated as a income and it also will be taxable. So investments are not fully disclosed. Some investments are shown in the more values in the assets, but showing the so less amount in the accounting books. The differences will be asked by the IT authorities. Okay, those are the unexplained, undisclosed incomes are also taxable in the previous income. Okay, it will be taxable in the assessment year. Next topic. Income under section 2 subsection 24. Profit or gain. Income means whatever amount will be received by any person in different modes. They are called as a income. For example, business people earned profit. It is income to the business people. Profession, doctors, lawyers, chartered accountants, they earn the income. Okay, dividend received by person through investing the shares in any other company, you get the dividend. Voluntary contribution received by the charitable trust, political parties, religion trust, universities, educational institutions. So voluntarily some people contributed in charitable blood bank, eye bank, Rotary clubs, etc. So political parties like Congress and Janata parties and any parties contributed voluntarily by another person and received by political parties, it is a income to the persons. Special allowances given to the employees to perform the special duties, some special occasions, they are also income to the person. And capital gain. Capital gain, sale of land and building, sale of assets, sale of furniture, etc. which gain and chargeable under the capital gains. Okay, winning from lotteries, winning from horse races, winning from card games, winning from puzzles, those any other games shows we get the income treated as a income. Okay, next horse races, etc. Export institutes. If you want to export goods from India to another country, the government will offer some special benefits to the exporters like cash, duty drawback, and special license fees, reduce the licensing fees, etc. Okay, any sum received by the employee, received by the SSC from his employer. So like provident fund, superannuation fund, bonuses received by the employee from the employer. Okay, next interest, salary, bonus, remuneration, commission received by a partner in a partnership firm, it is a income to that partner. Value of perquisites. Any value of perquisites like rent free accommodation, like free meals, free transport facilities provided by the company to the employee, they are valuable perquisites, they are also income to the person. There are some examples are given in the income. There are so many incomes in these points. Okay, next point. Capital receipt, revenue receipt differences. Okay, so capital receipt means simply say that huge amount will be received is called capital receipt. Small amount received will be called as revenue receipt. Depending upon the treatment, depending upon the item and situation, it will be changes. So received amount towards the fixed capital is called capital receipt. Okay, any capital amount will be received is called capital receipt. Received towards the circulating capital, it means current asset amount will be received. For example, okay, sale of any fixed asset, sale of goods is a revenue receipt, sale of fixed assets will be a capital receipt. Substitution of a source of income is a capital receipt. For example, if you sale of land for purchasing of machinery, it is a capital receipt, is a sale of land. Okay, substitute source of income, sale of goods, sale of waste material, sale of scrap, those are the revenue receipts. Okay, next compensation for surrendering of any rights like copyright, patent, trademark or any logos will be sold to the another one, will receive the some amount hugely. That amount is called capital receipt. Amount received for loss of the future profit. For example, if we are shifting our shop to another place or golden business to another place, so we have losses the some profit. So we will get the compensation from that person is called revenue receipt. Okay, where any assets will be sold under the fixes like land, building, machineries, like vacant lands sold, those are taxable under the income from capital gains, will be taxable under the income from capital gains. Okay, where sale of the trading assets like whatever the business will be done in the present, So the amount will be taxable under the income from business. If you are doing the cloth business, the income will be taxable under the income from business. If you are doing the gold business, that is the trading assets, like the gold taxable under the income from business. These are the difference between the revenue receipts and capital receipt. Next point. The differences between the capital expenditure and revenue expenditure. Capital expenditure means amount spending in the hugely is capital expenditure. Amount spending the mediumly or small is a revenue expenditure. So let us see the difference between the capital expenditure and revenue expenditure. If you purchase any acquisition of any asset is called capital expenditure. Purchasing of land, purchasing of building, purchasing of machinery, these are the acquisition of fixed assets is a capital expenditure. Purchasing of current assets or reselling of goods, like purchasing of stock, raw material, working these are the purchase and reselling of the goods. They are the revenue expenditure. Then expenditure incurred to increasing the operating of fixed assets. For example, the capacity of plant is manufacturing 1000 units. If you want to increase the plant capacity 2000 units to purchase another machinery, then it is the expenditure incurred the operating the fixed assets, increasing the operating facilities. So expenditure to maintain the fixed assets like repairs, like grease, oil, etc. will be maintained, labor charges, they are the revenue expenditure. Okay, maintenance of the fixed expenditure is the revenue expenditure. Next, payment of capital liabilities, like payment to the debenture holders, payment to the bank loans, they are to pay the huge amounts for repaying of the capital liabilities. That is called a capital expenditure. Payment of the current creditors, bills payable, outstanding expenses, they are the revenue expenditures. So payment of the current liabilities. Next one, expenditure incurred towards the sources of income. For example, purchasing a machinery. Purchasing a machinery is a sources of income for our livelihood is the capital expenditure. Earning of income through purchase as a fixed asset is a revenue income. Revenue expenditure incurred. So regular income earning. Regular income to earning spending the revenue expenditure. Okay. Those are the difference between the revenue expenditure and capital expenditure. If you like my class, please subscribe video channel, like it and share, comment and subscribe. Thank you for watching this class.